Hi everyone, very good evening. You're watching The Money Show on ET Now. I'm Mubin Akhbasi, and here's what we have lined up today on the show. First up, we'll be talking about this new emerging trend of ESG, environmental, social and corporate governance funds. These funds essentially invest only in those companies that adhere to the strict norms of ESG parameters. So what's interesting also is that firstly, we've seen so many mutual fund companies announce and launch schemes in this category. Flows into this category from investors has also been increasing, which means investors too are more and more interested in ESG funds. And finally, the returns in ESG funds as well have been pretty good so far. In fact, even better than the benchmark indices. So these are some interesting trends over here. That's what we'll be talking about today. We'll also be talking about how there's yet another bank that has slashed the interest rate on home loans, and this one is one of India's largest banks, Kotak Bank. And finally, we'll also be touching base on our topic of how to read an annual report, because do remember, it is annual report season time. You may be getting a lot of annual reports on your emails, via post. So we'll get you a guide on how to effectively get the best out of an annual report to judge whether a company is still worth holding on to in terms of their stock. So let's take on board our very first topic, and that is with respect to ESG. And for that conversation, I have with me Mr. Lovaii Navlakhi. He joins us now on the show. Mr. Navlakhi, as always, it's a pleasure having you with us on ET Now, and I hope you and your family are doing well amidst this pandemic. So like I said, there are lots of trends pointing to the popularity of ESG funds. And then there's, of course, the whole return bit as well that sort of justifies this emerging popularity. This is just one bit. We also have thematic funds. A lot of mutual fund houses are now launching even thematic funds, technology funds, pharma funds, so on and so forth. So let's get in your view first on ESG funds.
So yeah, I think ESG as a trend has been around in Europe for a long time. And I suppose Europe was the leader in trying to ensure that people and companies invest in areas which are sort of friendly for the environment, they are socially responsible, have got good labor practices, etc. And of course have very strong corporate governance. But actually, if you see the sort of big move has happened post the pandemic. So internationally, from what one reads, I think in the April to June quarter, there was almost $71 billion which went into ESG funds. The total size of the ESG funds crossed $1 trillion. And suddenly everybody is waking up to the fact that maybe, we as human beings have done wrong to the earth. Which is why the pandemic has hit us, and therefore we should be a lot more conscious. So if I sort of break down the components of ES and G, I think the G portion, which is the corporate governance, was something that came to the fore in India maybe a couple of decades ago. We sort of remember it around the time of Infosys, that it had such strong corporate governance that it always had a premium. And you started looking at companies which had very strong corporate governance. So I would probably, say that most of well-managed companies may have the governance piece in place, but I think the consciousness or awareness about E and S is sort of rising now. And I think that in India, if I may say, while a lot of funds are sort of launching their own ESG fund, I'm not so sure whether there are very clear defined benchmarks of the methods by which each of these funds will select a company and what is their rating on E and what is their rating on S and what on G, and then pick them into the ESG category. So I think this is some perspective one needs to keep in mind. I know that returns of these funds have tended to be better because you tend to pick better managed companies during a situation like the pandemic, where people are now talking about a K-shaped recovery, better companies doing much better, the laggards really doing much worse. Obviously, companies which have sort of focused and a little forward looking into areas such as environment and socially responsible practices might get an edge. and therefore possibly we are seeing this sort of interest grow.
Yeah, it's the G bit of it, especially that from an Indian perspective as well. Understandably, that investors focus on the G. Of course, stands for corporate governance, and naturally, during these tough times, during this pandemic, companies with good quality, good corporate governance quality, are the ones that will succeed, and that's the trend really that we have witnessed. Mr. Navlakhi, what's your view, meantime, on thematic funds? That as well is an area which is seeing a lot of at least two key trends are standing out. One is that again, mutual fund houses, are launching a lot of funds in this space, technology funds, so on and so forth. And the second is that obviously, and I speak for two funds, especially pharma and tech, have really been the flavor of the season. But would you advocate them for investors?
Yeah, I think whenever we have seen thematic funds first and foremost have been in practice for a long time. I sort of wet my feet in mutual funds for the first time in maybe 1999 with technology funds and really burnt my feet really. But I think that what we have to remember is that as soon as you use the word thematic, you understand that it's the theme for that particular either season, quarter, decade, whatever, so and you hope that I want to make that little extra money by investing in a sector which is growing faster than the rest of the market. I think the important thing which we realize as financial planners and advisors is that really that extra alpha that you're trying to get on betting on a particular theme really needs to get restricted, because when the sort of turnaround happens or the downturn happens on that particular theme, you sort of get stuck for a long time. And we've seen that with infrastructure funds, in the past, with the previous government, then again with the current government coming in the first time, there was a lot of hope that there will be a big thrust for infrastructure. And some of that has not played out. I think it's important to also recognize that diversified mutual funds will automatically overweight themselves in sectors which are expected to do well. So if today pharma and technology are sort of leading the returns over the last quarter or half year, you will find that diversified equity mutual fund will have some sort of excess weightage on those sectors any case. So I'm not really so sure what's the big sort of kick you get by allocating money into a thematic fund, because the theme may not last for that entire period of, let's say, a year, which in an equity fund is the period when your investment becomes long term. And therefore, you might have to exit at short term, pay some taxes, maybe even pay some exit loads and exit the fund. I think sitting with diversified really works. A sophisticated investor may say, okay, at this point in time, I want an extra 5%, 10% of my portfolio in pharma or technology or a combination. But that's about the maximum that we would sort of feel comfortable to advise to a client. Or clients are free to decide and investors are free to decide how much they want to put in it. But beyond 5 to 10% in a thematic or even a combination of thematic funds is fraught with risk, and one has to be careful of that.
Okay. All right. Mr. Navlakhi, so you seem to be okay with technology funds, but yes, obviously a limited amount, 5 to 10%. But I just want to clarify, would you have this view for just any thematic fund that's out there? Because we have so many, right? We have consumption, we have pharma. So just want to get that clarified, for our viewers in case they've missed your point when you were referring to the previous answer.
No, what I was meaning is that overall, as a concept, restrict the amount that you put in thematic fund. Doesn't matter what fund it is, whether it's technology, pharma, infra, consumption, whatever it is. I mean, obviously, it feels attractive and it seems like the flavor of the day and the season. So you want to try and make the extra return, but rest assured that your diversified equity mutual fund will have excess weightage in the sectors which are doing well. So you don't really need to take the risk of jumping over stones on a river and trying to cross over without getting wet by jumping from one thematic fund to the other and so on and so forth.
Okay, welcome back. We're in conversation with Mr. Navlakhi on this emerging trend around ESGs, around thematic funds. How much of your money should you put in them? Mr. Navlakhi, while you mentioned that 5 to 10%, and not more than that can be put in thematic, what's your view on ESG? Because that's, of course, a completely different ball game. You could consider them as large and mid-cap funds, the equivalent of that, of course.
Yeah, I think as a concept, like I mentioned earlier, I think ESG would be, companies which are sort of scoring highly on the approach to the environment, being environmentally friendly, having socially responsible practices, and of course, good corporate governance. So automatically, you're sort of trying to get a bunch of elite type of funds in this. And over the long term, I think it's certainly a good bet to have ESG type funds in your investment bucket. Now, the thing is that today you might not be able to separate out ESG companies or highly rated ESG companies from your large cap bucket. So you might want to be in the ESG category to try and get that alpha. But my guess is over the years, what will happen is that ESG will sort of percolate down to the markets, and you will automatically have some of the more the larger companies automatically being ESG compliant. At that stage, maybe you can think of going back to diversified. But at this point in time, yes, ESG is a good bet for you to park your money.
All right. Okay, let's take on board very quickly some questions and queries we've received. We have Jayaraman Jaykumar, who says that I want to invest in sovereign gold bond schemes for my daughter's marriage, who's 8 years old. And considering that they are maturable products, where should I invest the redeemed amount to have a continuity in my gold investments? A very interesting one, though, of course, it's a while away from now because, SGBs mature in 8 years. What would you recommend, Mr. Navlakhi?
So I think that SGB is a good option for somebody who wants to allocate money to gold, and in this case, there's a marriage that you're sort of saving towards. So it's at the end of the 8-year period that you invest this money, and all the returns on the gold investment will be tax free. Now, of course, you are taking a risk on the category because you're then hoping that the price of gold will be significantly higher 8 years later. In the meantime, you'll continue to earn 2.5% interest on your investment. Now, the question for me to answer, where should you put your money 8 years later when this matures, is extremely difficult because you don't know what type of products will be available at that point in time. And I think one will have to wait and take a call maybe a couple of months before the maturity, and not something that I can advise at this point in time.
Yeah, it's too early, really, because sovereign gold bond schemes, firstly, a new product that was sort of, released, I guess, just about 1 or 2 years ago. So we still have, even the earliest investor still has about 6 years, and we, let's just wait by for that. Okay, I think we have time for one more question. Ankush Khandelwala asks a question. Are life insurance policies which return money after the maturity good investments? All right, not sure if he has any other investments, but he seems to be looking at a product, a life insurance product, as also something that would give him a good investment opportunity. What would you recommend, Mr. Navlakhi?
Normally, one would suggest that leave life insurance to do the job of term insurance, and just buy the term insurance product and make your investments elsewhere, whether it's mutual funds or stocks or combination of all of that. But I think that the more recent trend that I have seen where the life insurance savings products seem to work is for people who are heading to retirement, where the worry is that interest rates will keep coming down. I heard you mention at the start of the show, Kotak having dropped interest rates again. So you want to make sure that during your retired life, you try and lock into an interest rate which is prevalent today. And if you can get it tax-free, nothing like it. So some of the life insurance companies have now launched life insurance products where you invest for 5 years or 10 years, and then the subsequent 25 to 30 years becomes sort of an annuity payout, but it's tax-free because you're getting a 10-time cover in that initial 5 year period. Just to clarify, you have to keep paying the premiums for the first 5 or 10 years, depending on what you opt for. But thereafter, your cash flows sort of that come in are tax-free. You're getting roughly 5.25, 5.5% post-tax, which I think is a good rate considering that that's the rate sort of prevailing today. And in case interest rates were to drop and get closer to the RBI target of 4% that they are aiming for, you might see interest rates falling even further. And at least in your retired life, you don't want to have the worry of where am I going to get that extra return from.
All right. Okay, thanks so much then Mr. Navlakhi for helping out our viewers with their questions and queries, and of course talking through us on what your view is with respect to thematic funds, ESGs. Well, viewers, if you would like to get your questions and queries on personal finance, mutual funds, insurance, your loans answered, you can do so by writing into us on The Money Show at etnow.tv. That's The Money Show at etnow.tv. All right, and with that, we'll take a very short break right here on the show. But when we return, we will be taking on board this emerging trend of how fixed deposit rates are trending.